Achha, now before we go to question number 15, we will understand and do a quick recap on what if there is an effective interest available or the market rate of interest on similar non-convertible instruments is available. So for example, there is a bond which remember we had discussed that standard example of a bond where we had a bond of rupees 10,000, issue price was 8863 and the market rate of, or let's say the bond was 10,000, the issue price was also 10,000, the market rate of interest on similar non-convertible instruments was 10%. However, the coupon rate over here was 7% and the term was 5 years. In which case, let us say this was an optionally convertible instrument, OCD, and this would convert, let's say these were this was one bond, so one bond would convert into, let's say, 100 equity shares. In which case, if I were to look at the working, rupees 10,000 would actually be split into the liability component as well as the equity component. Achha, the liability component over here would be, let us say, 700 rupees into the present value annuity factor of 3.791 plus 10,000 rupees into, let us say, 0.621, and if you total up, this is around 8863, and the equity component would come to 1137. Now this equity component would not change, this balance would remain the same. Now when we look at year 1, your opening balance of the liability component was 8863, EIR at the rate of 10% should actually become 886, coupon would be 700, there is no principal, and hence the closing would be 9049. Achha, now what I want to convey is, if a diluted EPS is to be calculated and you have been told that the profit is, let us say, 1 lakh. Now typically you add back interest, and as a natural instinct you would have added back 700 rupees, saying that the interest is a coupon. If nothing is given, the coupon amount is the interest. However, if you have been given this market rate of interest, you can calculate the liability component, and based on the liability component you can find the effective interest. And hence, had this been converted hypothetically at the start of the year, now one can always argue that the conversion can be done only after 5 years. We don't have to see that. A potential equity share means it has the potential to convert into equity shares. Whether it was legally possible to convert or not, or whether one would convert or not, is immaterial. You will always take that what will be the number of shares that would be issued if you were to convert. So let us say over here, if you were to convert, then apart from, let us say you are having 10,000 equity shares, apart from that you will also issue another 100 shares. Whether it was likely that the conversion will happen or not is immaterial. You will also include another 100 shares, and the liability component will no longer exist, because now liability component debit, equity component debit to share capital, in which case the liability component will no longer exist, and hence this 886 of interest will no longer come. Ajay, this 886 will now be added back into 1 minus t. So let us say there is 30%. Now this is also where experts in taxation may have a differing view. Okay, sir, tax may not be giving deduction on effective interest, they might give deduction on coupon interest. We are not going to go into that much of detailing, otherwise this will become a tax paper from an accounts paper. So what the institute has done is, well, if there is a tax rate, then whatever is the tax rate is applied on the effective interest unless it is given specifically otherwise. So this will help you in calculating the diluted EPS. Achha, now in case of optionally convertible instruments, the option may rest either with the holder or option may rest with the issuer. In every question that you have done and which has come in financial instruments, the option has almost always been with the holder. Now there is one question in the institute study material, in the RTP, in the mock test papers. This is one question which is doing the rounds everywhere for EPS, where you have an optionally convertible debenture but the option rests with the issuer. Now if the option is with the issuer, then how will we do if the option rests with the issuer, then how will we do the accounting? Well, the issuer is still under a contractual obligation to deliver cash for the interest. However, for the principal, the issuer may deliver cash or at his own choice even deliver shares. Now, ideally, the accounting should be dependent on the intention of the issuer. So, if the issuer intends that he will pay cash to settle this instrument, then you will treat it like a liability component. For example, he is not permitted to issue any more shares. He has reached the limit as per SEBI regulations. Or if the issuer does not have any cash only, if he believes that he will settle through own shares, then this should not be taken as a liability because you don't have an obligation technically. However, what has the ICAI done? Well, in questions where nothing is given, if nothing is given, like the one which we are just going to do as question 15, the ICAI has included this as a part of the liability component. This is probably based on an assumption that the issuer might settle in cash, and hence, I mean, it is, unless it is given that they will necessarily issue equity shares, they might have to pay cash, and as a result, the liability exists. It is not a compulsorily convertible instrument, so your liability exists, and hence institute takes it over here. Aja, so this is the one and the only question on these lines, and hence I would strongly recommend you to follow the institute's version. And it is not that it is wrong, but it is not that that is the only solution possible. There can be an alternative solution as well. Well, one may assume that the issuer believes that the settlement will happen in shares, in which case you will not take this in the liability component calculation. Now, the challenge that you might face over here, or the dilemma you might face over here, is if we are taking this 10,000 over here, we are implicitly assuming that the liability is going to be settled in cash. If the liability is going to be settled in cash, then there will be no shares to be issued. This is where a student logically thinks, and rightly so. Logically, if you are believing that the settlement is going to happen in cash, that is when you are saying that, okay, then I am under an obligation to deliver cash for 10,000. In which case, if you are going to settle in cash, then you will not issue shares. And hence, people would say, okay, chalo ek kaam karto hai, to fir yahan pe 100 nahi lete. This is where you would go wrong. The standard on EPS does not ask you whether the shares are going to be issued or not, whether you believe shares are going to be issued or not. The standard says, are there any shares which have the potential? Whether that potential will be realized by exercise or not is irrelevant. Do they have the potential to convert into equity shares? Yes, then you take it in the denominator. And hence, irrespective of what you take for calculating the liability component, like, to be honest, over here, when you look at an optionally convertible debenture where the option is with the holder, you have still taken the 10,000 in the liability component, right? But you still take 100 shares. Yes, here we don't have the option. Still, the denominator is always dependent on the number of shares where the potential to convert is there. Whether the potential to convert will be materialized or not is irrelevant. And as a result, you will always take the 100 shares in the denominator, irrespective of whether you believe that the potential to convert is going to be exercised or not. So over here, keeping that in mind, we will go to question number 15, a definite important question. A lot of the questions that we are doing here are important. Then we will proceed on to 16, which is also an equally important question, and 17 as well. So this is an exam question. So 15, 16, 17, all three of them being fairly important questions from an exam perspective. So you'll have 11, then 14, 15, 16 and 17. Okay, let us go to question number 15. An entity issues 2,000 convertible bonds at the beginning of year 1. The bonds have a 3-year term and are issued at par with the face value of rupees 1,000 per bond, giving total proceeds of rupees 20 lakhs. Again, entity issues 2,000 convertible bonds from the beginning of year 1. They have a 3-year tenure, issued at par, value of 1,000. So this is the 2,000 into rupees 1,000, which comes to 20 lakhs. So this is the issue price, giving total proceeds of 20 lakhs. Now interest is payable annually in arrears, which means that is at the end of the year, at a nominal interest rate of 6%. So your coupon over here would be 20 lakhs into 6% will come to 1,20,000. Okay. Each bond is convertible at any time up to maturity into 250 ordinary shares Okay, so your potential equity shares would be, here you don't have multiple conversion ratios. There seem to be 2000 bonds, and each bond has a potential to convert into 250 shares, and hence these 2000 bonds will probably have the potential to convert into let's say 2000 into 50, which is 5 lakh equity shares. So over here they would have the potential to convert into 5 lakh equity shares. Okay, the entity has an option to settle the principal amount of the convertible bond in ordinary shares or in cash. So this is an optionally convertible debenture or an optionally convertible bond where the option rests with the issuer. The first and probably the last case where you have an optionally convertible bond at the issuer's choice, where both the alternative treatments are possible. Okay, when the bonds are issued, the prevailing market rate of interest for similar debt without a conversion option is 9%. These are the golden words. These words were not given in question number 14. They were not given in question number 11. They were not given in any other question that you have done. And because of this, you were unable to split the liability and equity component. In every question where there is a convertible bond, there is a possibility that there might be a liability component and equity component, and you can find the value of the liability component on which you can apply the EIR. In this case, you have been given the market rate of interest on a similar non-convertible instrument through which you can actually find the liability component, which was not possible in the earlier cases. Okay, at the issue date, the market price of one ordinary share is ₹3. Now, the only objective of giving this is to confuse you. Now, one can always say that, okay, if the market price is 3, then is a conversion likely, is a conversion unlikely? You don't have to think about that. For example, one can always think through, and this is not required, is, well, one bond, if the bond redeems, if the bond is redeemed, you will have to pay ₹1,000. However, if the bond converts, you will have to issue 250 shares, and every share is worth ₹3, and hence this will eventually settle at 750. So one can always argue that as an issuer, you would prefer to settle by converting only because saste mein ho raha hai. But again, there are a lot of other factors. You don't know whether the issuer wants to dilute his stake by issuing, whether he wants to issue, whether it is permitted to issue. A lot of other things are there. So both of these are realistic possibilities. And unless the question tells you a specific data about the issuer's intention, it can be any of the two. Okay. So over here we have to ignore how much is the total amount that is on conversion. Income tax is ignored, so that is, thank you to the question for ignoring that. Next question we will have to consider it. Calculate the basic as well as diluted EPS when the profit attributable to ordinary equity shareholders of the parent is, let's say, 10 lakhs. Ordinary shares outstanding are 12 lakhs and convertible bonds outstanding are 2000. This is profit of the entity for year 1. We can also see an extra case that what will happen if it is year 2. Your solutions will be slightly different. If you want, just pause the video and read the question again once. So over here you have question number 15 to start with. Now, if I want to calculate the basic EPS, remember the net profit is always calculated after deducting interest. In fact, it is clearly given that this is net profit attributable to ordinary shareholders, which means this has to be after deducting interest for sure, net profit, which is attributable, and hence this is ₹10 lakhs. Achha, you will divide this by your ordinary shares outstanding, assuming they are outstanding for the entire year. So this is 12 lakhs. So this is divided by 12 lakh shares. So this is 10 lakhs divided by 12 lakhs, which is equal to ₹0.833. This is your basic EPS. Achha, then we look at diluted EPS. Now, diluted EPS, what you do is you start where the basic EPS ends, which means in the numerator, you will add back interest. because this 10 lakhs is calculated after deducting interest, and in the denominator you will add back the number of shares which are potential in nature. So over here, when you try to add back interest, the interest that is to be added back is the interest that must have been deducted. While calculating 10 lakhs, how much interest would we have deducted? Well, we would have deducted the effective interest, and as a result, what you can add back, had there been conversion at the beginning, would also be effective interest. Sir, why? Because this 10 lakhs must have been calculated after deducting an interest, which must be the interest only on the liability component, and hence, had the conversion happened, that interest that you have deducted would not have arisen, and as a result you will add back that amount. But in order to calculate the effective interest, you will have to find, in order to calculate the effective interest, you will have to find the split between the liability component and the equity component. So this is rupees 10 lakhs, which you bifurcate, which you split between the liability component and the equity component. Okay, the liability component will be the present value of future cash flows, which means 10 lakhs into the coupon rate. Issue price is 20 lakhs, right? The issue price over here is 2000 bonds into rupees 1000, so this is rupees 20 lakhs. So you are under a contractual obligation to deliver 20 lakhs into 6%, that is a coupon, not just for 1 year, this is for a period of 3 years. So this is into PVAF, this is into PVAF at the rate of the market rate of interest on similar non-convertible instruments. So this is 9% for a period of 3 years. Now this is absolutely fine. However, the challenge arises that what about the principal component? The institute over here has assumed, and I'll again repeat, there's an alternative solution possible. The institute over here has assumed implicitly that since nothing is given, there is a obligation, or there may be an obligation in which you may settle cash. You might issue shares, but as an issuer, you may also settle cash, and hence there is a liability. Sir, we can assume that these are the issuer wants to settle their own equity. Yes, you can. Your answers will be different, but here, in line with the ICAI solution, they have taken 20 lakhs along with the liability. It is not that this is wrong, but it is not that this is the only solution possible. There's an alternative solution possible as well. So this is 20 lakhs into the present value factor at the rate of 9% for the third year. So over here, this will be 1 divided by 1.09, 1, 2, 3. This is 0.7722, and grand total will be 2.5313. So this will be 20 lakhs into 6%. This is 1 lakh 20 into 2.5313, which is 3,03,756, which definitely there is an obligation to deliver cash, and then there is 20 lakhs into 0.7722 M plus, which is 15 lakh 44,400, which is 18 lakh 48,156. 1848,156. Okay, so this is your liability component. Achha, the remainder will be shown as equity, which honestly does not really matter, but for academic completion, this is 1,51,844. Now, the rupee value does not really matter while calculating diluted EPS, because in the diluted EPS you don't take the share capital or anything in rupees, you take it in number of shares. So if you were to calculate diluted EPS now, the diluted EPS will be calculated by taking 10 lakhs and adding to that the effective interest on the liability component. So let us try to calculate that. So the diluted EPS will start where the basic EPS ends, that is rupees 10 lakhs, and to this 10 lakhs you will add, in the first year you will have 18 lakh 48,156 into 9%. Thankfully the tax rate is not given, so this is 1 minus 0. However, if the tax rate was given, you would have taken that. This divided by, you have 12 lakh shares which were outstanding for the entire year, and these convertible bonds were issued at the beginning of year 1, so which means they were outstanding for the entire year, which means if they are converted, they will get converted into how many shares? Well, there are 2000 bonds and each bond can get converted into 250 shares. Sir, but who said that they will convert? We will settle by issuing cash. That does not really matter. Are they potential? Is there any potential in these bonds to convert to shares? Yes, there is some potential, and hence you will consider it. So this will be, let us say, rupees 10 lakhs plus, this is 1848,156 into 9%, so this is rupees 1,66,334, rupees 166,334, and then you divide this by let's say 2000 into 250, which comes to 5 lakhs, and hence this is 17 lakhs. So over here you will have 11 lakhs 66, or let's say 10 lakhs plus 166 334 divided by 17 lakhs. So this is rupees 0.686. If you compare this with the basic EPS of 0.833, this is lower, and hence this is considered to be a diluted EPS. Are we clear with this? So if you can refer the solution as well if you want to. In that we have given the reference notes and we have explained the treatment of the liability component as well as why we should take the entire 5 lakhs in the denominator as well. Okay, so that takes care of question number 15, a definite important question. Then we go to question number 16. Now this is a very important question, has a lot of nitty-gritty involved, and requires some basic understanding of consolidated financial statements as well. So when you look at consolidated financial statements and overall financial statements, there is something called a statement of comprehensive income. What do you mean by statement of comprehensive income? First of all, even if you look at the standalone statements, you will have the P&L account, and P&L will comprise of, let us say, revenue, expenses, karte you will get PAT. And below PAT you have other comprehensive income, and other comprehensive income you can have changes in reval reserve. You can have, let's say, changes in reval reserve. You can also have changes in fair value reserve that have happened during the year, which are to be classified as other comprehensive income. So you can have various such items, and hence one can say that okay, your revenue earned during the year is probably 1000, your expenses incurred are probably 600, so your PAT is 400. Now during the year certain PP has been revalued, upward revaluation 100, certain investments have been also remeasured 200, and hence your total in other comprehensive income is 300. And hence if one says what is the comprehensive income, we will say 400 in the form of profit and 300 in the form of changes in other reserves like revaluation, fair value reserve, etc. And hence your comprehensive income is 700. Now the question arises that if you have to calculate EPS, and this never happened in your inter CA, because in your inter CA you always had only income statement, there was nothing called as OCI, but here you also have OCI which is shown along with the income statement. So the question arises that when you calculate EPS in the numerator, should you take the PAT, should you take only OCI, or should you take other comprehensive income and PAT, which is comprehensive income? So the standard has clearly mentioned that this is based on net profit available for equity shareholders, and net profit does not include other comprehensive income. So it does not include OCI. Sir, why? Well, this will also include changes in other reserves like remeasurement reserve, or let us say revaluation reserve. Now these are technically not a part of your distributable profit, and as a result to take that into your EPS calculation would be wrong. And well, revaluation reserve even changed earlier. Even in under AS there could have been a change in the revaluation reserve which directly was adjusted against reserves. All reserves belong to shareholder undoubtedly, but when you calculate EPS, EPS does not take the change in all the reserves. It takes the change only in the revenue reserve, that is basically net profit. And as a result, even if an OCI is given to you and a comprehensive income is given to you, you have to remember that your statement of net profit or PAT is taken as a base. So your EPS is always calculated based on PAT. Sir, but other reserves, they belong to the shareholder. Yes, they even belong to the shareholder in your AS20 inter-CA. But we want to calculate earning per share, which probably may be distributed. These reserves may not be distributed, and as a result, we are looking at only the net profit. This is stipulated in the standard, and hence every company takes the net profit as a base. So they will calculate EPS based on 400 divided by shares and not 700 divided by shares. Okay, perfect. So first you will take net profit as a base. Secondly, in the consolidated financial statements, we have not done consolidation, so this is something which will require, let us say, a bit of background. In your consolidated financial statements, what will happen is, let us say there is Reliance Industries Limited and then there is Reliance Jio Limited. So there is Jio and then there is RIL. Now RIL has equity share capital of 1000, which is made up of 1000 shares of ₹1 each. Let us say this is held by Mr. Mukesh Ambani. Now it has certain assets and it has also made investment in Jio, let us say for a 70% stake. Let us say for simplicity this is 70. Now let us say the equity share capital of Jio is 100 rupees. Let us say these are 100 shares of ₹1 each for simplicity. The net profit of RIL standalone is, let us say, 10,000 rupees. The net profit of Jio standalone is, let us say, 1,000 rupees. Acha, when I prepare consolidated financial statements, what will happen? Well, when I prepare my consolidated balance sheet, please pay attention. You have not done consolidation, at least in your final CA, but nevertheless, you might have some background from inter-CA as well. In any case, you can try to understand. When you prepare the consolidated balance sheet, you consolidate all assets, all liabilities of the parent and subsidiary. So Reliance ke jitne bhi assets hai, Jio ke jitne bhi assets hai, we will consolidate. However, this investment is in Jio, and now in CFS, Jio and Reliance are one and the same. In SFS, they were different. So you can't have an investment in your own self, and hence you try to eliminate this investment. Again, you have equity share capital. Now, like you had done in your amalgamation or so, there can be intercompany debtors and creditors. The acquiring company may be having a receivable from the selling company, and the selling company may have a payable, and hence they will cancel at the stage of consolidation. In a similar way, over here, you will have an investment in Jio, let us say to the extent of 70 shares. But that investment is exactly represented by 70 shares within this 100, and as a result we will eliminate against this equity share capital. We'll try to do that in the process of calculating goodwill, but we will say 70 ka jo humne investment kiya is actually investment in subsidiary share capital. So on one side I'm seeing investment, on the other side I'm seeing share capital, that is intercompany, and hence that will be eliminated. However, there are still 30 other shareholders in Jio which are outside the group. So that is not Reliance Industries, they are other shareholders, they are also owners, and hence what you will do is, technically, if I were to pass the elimination entry, this would be, let us say, equity share capital of Jio, you will try to eliminate from your books, and this will be the entire 100 rupees. But out against this 100, loosely speaking, you will eliminate it against the investment, but only 70 will get eliminated. But what about the remaining 30? Well, that is held by shareholders who are non-controlling, and hence this will be NCI. To NCI, this will be 30. And hence what will happen in your consolidated balance sheet is, you will see the share capital only of the parent entity. This is Mr. Mukesh Ambani, 1000, and apart from that, you will have NCI, the non-controlling shareholders in the subsidiary. Okay. Now, non-controlling shareholders have a 30% share in all the net assets as well as all the net profit of Jio. They do not have any share in Reliance Limited profit. So when you look at NCI, NCI is the 30% shareholders of Jio. They don't have any share in this 10,000. However, they do have a 30% share in this 1000, and as a result 30% of this 1000 is attributable to NCI, that is 300. And hence, while you prepare consolidated balance sheet, we will say that okay, your consolidated net profit should ideally be 10,000 plus 1,000, but out of this 1,000, 30% is not attributable to these shareholders. 30% is attributable to this NCI, and hence you will add that 30% to this NCI, let us say. In which case, over here, when we look at the consolidated profit and loss, the consolidated profit and loss technically will be 10,000 plus, let us say, 1,000, that is equal to 11,000. However, out of this 11,000 at the end, you will see that there will be something like this. So this is attributable to NCI. Acha, you will not take 30% of the entire 11,000 because parent ka jo profit kamaya hua hai, that is attributable to the parent shareholders only. Again, whatever is the profit of Jio, a part of it is also attributable to parent shareholders. So a part of 1,000 is also attributable to Jio, Reliance shareholders, but not the entire 1,000, and hence we can say that the profit which is attributable to shareholders of the parent in total will be, let us say, 10,700. Okay, so now the challenge arises that while you are calculating EPS, should you take 11,000 as a base? Forget OCI. OCI to humko lena hi nahi hai. We are talking about net profit. Should you take this 11,000 as a base? That is the net profit for the entire group, including the NCI share of net profit, or you should take only the net profit attributable to the parent. Now, this has to be dependent upon how you calculate EPS. So when you calculate your EPS, in your basic EPS or even diluted EPS, you will take some profit in the numerator, but then the question arises, what will you take in the denominator? So you will take the number of shares, but number of shares of whom? Will you take the number of shares of the parent, or will you take the number of shares of parent plus the non-controlling shares of the NCI? No, you only take the number of shares which are appearing in the share capital. And if you look at the share capital, you can open any of your inter-CA sum, where there you used to call it as minorities interest, but or if you have had some practical exposure of consolidation, you look at any balance sheet. In the consolidated balance sheet, the number of shares that appears, or the share capital that appears, is the share capital of the parent only. NCI will appear as a separate line item in which you will not mention kitne shares kya. NCI might be, here there's one subsidiary, there might be 100 subsidiaries, Tata Steel has 500 subsidiaries. So all of them together will give you the NCI, but the share capital of Tata Steel Limited, which is the share capital of the parent, will appear in the consolidated balance sheet. The share capital of the subsidiary, to the extent it is held by the parent, will be eliminated. To the extent it is held by the outsiders, will be shown in minority interest or non-controlling interest. You don't say how many shares. You just say, bhai, theek hai, this is minority interest, which means the shares over here are the shares of the parent. And if you are taking the shares of the parent, then it is very logical that you should take only the profit which is available to the parent. It is like saying that in the denominator only 1,000 is going to come, not 1,000 plus 300, because it is illogical. 300 shares or 30 shares, for example, are held by the non-controlling interest, but these are shares of Jio. You can't add the shares of Jio and shares of Reliance, right? They're completely two different things. And hence we will say, okay, we will take the shares of the parent, that is Reliance Industries Limited, and hence you should take the net profit which is attributable to the parent. We have given reference notes to this effect, but I hope you have been able to make sense of what we have just discussed, and hence this is 10,700 divided by 1,000. If you understand it, well and good. If you don't, remember two basic rules. First, your EPS is calculated based on net profit, not based on OCI, not based on statement of comprehensive income, based on net profit. Second, this is profit attributable to the equity shareholders of parent, and hence you will divide this by the number of shares in the parent. So you will take the profit attributable to the shareholders of the parent. You will not take the NCI. This is the second point. The first point we had discussed over here was for the OCI. Second point is you will ignore the NCI's non-controlling interest share. Third is, now sometimes there might be certain instruments like irredeemable preference shares with discretionary dividend. Achha, now if someone asks you what is a classification for this, you would say that if it is irredeemable, then the principal has equity features, and if there's a discretionary dividend, again the distribution also has equity features, and hence this instrument will classify as equity. It will classify as equity but not as equity shares. When you calculate EPS, EPS is earning per equity share, not earning per equity. Equity के अंदर बहुत सारे line items हो सकते हैं, but when you calculate EPS, it is specifically earning per equity share, and as a result, if you calculate EPS, EPS will take net profit. Achha, now since this is equity in nature, it is discretionary dividend, but it is possible that in the current year you might have paid them some dividend. Achha, where would that dividend have gone? Where do you think that dividend would have gone? Would that have gone as finance cost? No, because it is classified as equity. Would that have gone as an appropriation, that is directly as charge against retained earnings? Well, yes. And as a result, this net profit that you see in your income statement will be before deducting this preference dividend. The EPS that you want to calculate is the earnings per equity share, and equity shares will get money after salaries, rent, debentures are paid, but also whatever is to be paid to the irredeemable preference shareholders are paid, and hence over here you would deduct the preference dividend separately, because this preference dividend, which is a part of an equity instrument, would have gone in retained earnings, and in the denominator, when you take the number of shares, you will take the number of equity shares only. It is EPS is not, I'll keep on repeating this again and again, EPS is not earning per all components of equity, it is earnings per equity share, earnings per share. So that is earnings per equity share over here, and if you're dividing it by the number of equity shares, you have to take the profit available to equity shares, which is after deducting preference dividend. Perfect. So this works well. The challenge arises the moment you take diluted EPS, your understanding is not as deep. So what you do is, okay, irredeemable preference shares are in the nature of equity, and hence if you take the diluted EPS, the preference dividend will be saved. You add that in the numerator, something you add in the denominator. Diluted EPS does not tell you that you add back only the equity components. It says you have to add back instruments where there are potential equity shares. I'll again repeat, it tells you that you have to add back instruments where there are potential equity shares. Acha, what do we mean by potential equity shares? Potential equity shares refers to instruments which have the potential to become equity. Acha, does an irredeemable preference share with discretionary dividend have any conversion feature? Can it become equity? No. Acha, is it classified as equity? Yes, but can it become an equity share? No. And hence, even though this is classified as equity, it does not have the potential to become equity shares, and hence it is not a part of diluted EPS calculation. It is not a potential equity share. This is what you have to drill down very clear in your mind, because by default, and I keep on getting this query up to the exam, that sir, we have forgotten to take the irredeemable preference shares in the diluted EPS calculation. We should have added the dividend back and the number of shares. Where is the potential equity share? It is equity in nature, perfect, but the standard in diluted EPS does not tell you that whatever is equity you take for diluted EPS calculation. No, it says whatever instruments have the potential to become equity shares, you take. Does this instrument have any potential to become equity share? No. And hence you can't consider this as a potential equity share. It will be classified within equity, no one is denying that. But a convertible debenture, a convertible preference share have the potential to become equity share. This does not have the potential to become equity share. Okay, so keeping all that in mind, we'll go to question number 16, a very important question. It was also based on a past GFRS case study which came into the RTP, but it's very, very important. It covers everything from compound financial instruments to irredeemable instruments to other comprehensive income to NCI. A definite revision before your exam. So let us read this. Now CAB Limited is in the process of preparation of consolidated financial statements of the group for the year ended 31st March 2013. Okay. So this is CFS for the group. year ending is 31st March 13, and the extract of the same is as follows. So you have profit for the year, which is attributable to CAB, attributable to the non-controlling interest, and hence the total profit. Then you have other comprehensive income and total comprehensive income. So there are 6 numbers, but you have to filter out and find the one relevant number that you have to take. First of all, other comprehensive income and total comprehensive income do not go into the EPS calculation. It is only the PAT. So the first filtration is we'll take the PAT. So all of these numbers, at least for an EPS calculation, are irrelevant. Now, when you look at the PAT, there is some PAT attributable to the shareholders of CAB, some attributable to the shareholders of the subsidiaries, which are other shareholders, non-controlling, and then the total. You have to remember that what are you going to take in the denominator? You are going to take the shares in the parent, and hence you should take the profit attributable to the parent. The profit attributable to NCI is irrelevant. The total profit is not considered. 39,000 is the base. This is something which is interesting. A note is given. You should refer that as well. Profit for the year attributable to the ordinary shareholders of the parent, which is typically given in almost every question. Here you have to select that. So 39,000 is the first decision. Second, the long-term finance of the company comprises of the following. This is what? 20 crore equity shares at the beginning. So this is, I think, this is rupees in 1000. Everything, it's not just total, everything is rupees in 1000. So this is rupees 1000. There is यहाँ पे total number है. The long-term finance of the company will include 20 crores. अच्छा, if you have to take it in 1000, ये last के 3 number हटा देने के. It includes 20,000 or 2 lakhs in thousands equity shares at the beginning of the year, and the company has issued 50,000 shares on 1st of July 2012 at full market value. So there has been a fresh issue of shares for consideration. This will help you in the calculation of weighted average number of equity shares. Okay, there are what? 80,000 irredeemable preference shares. These shares have been in issue for the whole year as on 31st March 13. The dividend on these shares is discretionary, and hence these instruments are classified as equity, and hence any payment made to them would be charged to retained earnings. Okay. Apart from this, there are 18 crore of 6% convertible debentures. There are 18 crore rupees of 6% convertible debentures. These are convertible debentures issued on 1st of April 11. That's a year back. And repayable on 31st March 15. So that is 11, say 12, 13, 14, 15, 4 years at par. Now, interest is payable annually. As an alternative to repayment at par, the holder on maturity can elect to exchange their convertible debentures for 10 crore ordinary shares in the company. So over here, this is an optionally convertible debenture where the option lies with the holder. On 1st April 2011, the prevailing market rate of interest for a 4-year convertible debenture which had no conversion right was 8%. Achha, so this is given to you. These are the golden words. If these are given, only then can you split the liability component. Using an annual discounting rate of 8%, the present value of 1 rupee payable in 4 years is 0.74, and the cumulative present value of 1 rupee is 3.31. So this is given to you, PVF as well as PVAF. Okay, can this be treated as potential equity share? Yes. These have the potential to become equity shares, and potential to become how many equity shares? Well, they have the potential to become 10 crore ordinary shares. Irredeemable preference shares, though they are classified as equity, they don't have the potential to become equity shares. Achha. In the year ended 31st March 13, CAB declared an ordinary dividend of 10 paise of rupees 10. Just cancel this paise. Ordinary dividend of rupees 0.1 per share, and a dividend of rupees, just cancel this paise please, and a dividend, this is 5 paise or rupees 0.05 of rupees 0.05 per share on the irredeemable preference shares. Okay. See, this dividend of 0.1 which is paid to the ordinary shares is out of the pool of money they have. So that 39,000 that they have technically could have been used for any purpose. No. Out of that 39,000 which is attributable to CAB, from that you will have to deduct the preference dividend because they are classified as equity, and after that whatever money is left is attributable to the ordinary shareholders of CAB. Now whether you distribute it or you don't is irrelevant, and hence that 0.1 of dividend is paid to the owners only. So that does not really matter, but 0.05 goes outside, and then whatever is left after payment of 0.05 is attributable to the owners. Okay. Compute the following: the finance cost of the convertible debentures, okay, and its closing balance as on 31st March 13. They were issued on 1st April 11. So this is like an IND AS 109 question to be presented in the consolidated financial statements, and then the basic and the diluted EPS per share for the year ended 31st March 13. Assume the income tax rate, Satyanash, of CAB and its subsidiaries is also 25%. So that's the same line that has got printed again. Are we clear with this? Yes, Acha. So if you want, read the question again. You will definitely need to absorb it slightly better, and then we can proceed. If you have read it, then question 16. First is basic EPS. Basic EPS will equal the starting point, that is 39,000, but this 39,000 is after considering the payment made to NCI, because the parents shareholders are going to be taken in the denominator. It will not include the OCI. However, this is net profit, and profit is after all expenses but before appropriations. If there are irredeemable preference shares, the payment made to irredeemable preference shares would be deducted from retained earnings. Yes, there is also a convertible preference share, but convertible preference share के ऊपर जो भी interest आता है, that is liability component into the effective interest rate, and that must have gone in finance cost. So you don't have to subtract that again, because 39,000 will be calculated after subtracting interest on the liability component. However, 39,000 would actually be before subtracting any preference dividend, and hence we will have less. You have I guess 80,000 preference shares, and to 80,000 in thousands, so everything is thousands now, 80,000 in thousands into rupees 0.05. So this is minus 80,000 into rupees 0.05. So this will give you the amount available to the shareholders, but shareholders of whom? Well, shareholders of CAB. And how many equity shareholders are there of CAB? Well, there are 2 lakhs for the entire year. So this is 2 lakhs in thousands. Everything is in thousand into 12 by 12, and another 50,000 which was issued on 1st of July 2012 and hence outstanding for 9 months. So this will give you rupees 39,000 minus, I guess, rupees 4,000 or 400. क्या है ये 80,000 into 0.05 is 4,000 upon, this is 2 lakhs and this is 50,000 into 9 divided by 12. This is 37,500. So this is 2 lakhs plus 37,500. Don't make the mistake of adding this 80,000 and say that this is outstanding for the entire year, so plus 80,000 into 12 by 12. These are preference shares. We calculate EPS for equity share. So over here, this is rupees 35,000 and you divide this by 2,37,500. So this is 35,000 divided by 2,37,500. So this is rupees 0.147 basic EPS. Achha, next you want to calculate the diluted EPS. So for diluted EPS, you will have to add whatever are the potential equity shares, but you will also have to add the interest which is paid. Now 39,000 or 35,000 as a case maybe is after deducting preference dividend, but it is also after deducting interest, but this is not coupon interest, this is effective interest. So you'll have to find this. So before you do the diluted EPS calculation, or while doing the diluted EPS calculation, you will have to split the issue price. The issue price over here seems to be 18 crores. So if you take 18 crores in 1000, calculator pe le lo, gadbad nahi fir. So you take 18 crores divided by 1000 comes to rupees 1,80,000 in thousands. Okay, you will split this into the liability component and the equity component for academic completion, though the rupee value of equity component is irrelevant. This is optionally convertible instrument where the option is with the holder. If the option is with the holder, then you are under a contractual obligation to deliver cash. So this is very straightforward. There is no ambiguity here, unlike question number 15. So rupees 1,80,000 into the coupon rate. What is the coupon rate? This is 6%. Okay, you are doing this working on 1st April 11. Okay, into 6%. Sir, we are in the year 1213. I know that, but the split happens on the date of issue. Aja, so this coupon, you are under a contractual obligation to deliver cash for a period of 4 years. 11, 12, 12, 13, 13, 14, 14, 15, 4 years. The market rate of interest on a similar non-convertible instrument is 8%. So over here, if this was a pure liability, people would have expected 8% for a period of 4 years. However, since you are under a contractual obligation to deliver cash, because if the holder demands, you will have to pay cash at the end of the 4th year. This is into the present value factor at the rate of 8% for the 4th year. So this is 1 divided by 1.08, 1, 2, 3, 4. This is 0.7350 and this is 3.3121. So this will give you 1,80,000 into 6%. This is 10,800 into 3.3121. This is 35,771 plus 1,80,000 into 0.735. This is 132,300. So this is 1,68,071, and just for academic completion, the equity component over here will be, let's say, minus 1,80,000. So this is 1 lakh, or let's say 11,929. This will give you your equity component. Now equity component in rupees kuch bhi hone do, we have to find how many shares are potential which are given to us in the question directly. Okay, so let me just, oh, it is given to you, I'm sorry, we have been given present value factor, so we'll have to take that only, 0.74 and 3.31. So ek halka sa rounding off aa jaye, 0.74 and 3.31. So we can directly show ek halka sa rounding off aayega shayad se. So this is 1,80,000 into 6%, that is 10,800 into 3.31 M plus 1,80,000 into 0.74 M plus, and MRC, this is 168,948 minus 1,80,000, which is 11,052. This is 11,052. Perfect. Okay, so now what? Well, you want to find the coupons, and as a result you will prepare the effective interest table. So this is year 1, 2. Let's say the opening balance will be 168,948. The effective interest is at the rate of 8%. So this is 168,948 into 8%, which is 13,516. Coupon paid is 10,800, I guess. yes, and hence your closing comes to 171,663. Remember, this is the closing on 31st March 2012. You are in the year 31st March 2013. That is the second year. So this is 171,663 into 8% again. So this is 13,733 and less 10,800. And hence the closing over here will be 174,597. Achha, so the question is asking you what is the closing balance appearing in the balance sheet, which is 174,597. The question is also asking you what is the effective interest? Well, this is 13,733. It is in this year. Now, if you want to calculate diluted EPS, for the diluted EPS calculation, we will say that we will start where the basic EPS ended. Where the basic EPS ended at 35,000. Achha, this 35,000 is after deducting preference dividend, which should have been deducted, but this 35,000 is also after deducting the interest for the second year. If the bonds were converted, and they could have been converted at the start of the year because they were outstanding for the entire year, then this interest will not be charged. In any case, on equity component, you don't charge anything. This interest of 13,733 would not be charged if these bonds were converted at the start of the year. So this is, you will add back plus 13,733, but this 13,733 would have also had an impact on tax. The tax rate is given to you, I guess, as 0.25. And we are assuming that income tax would have given us deduction also based on the effective interest rate only. And as a result, what you add back over here is your interest net of tax. Perfect. So this is 13,733 into 1 minus 0.25. You will divide this by the actual shares, that is 237,500. You will start where the basic EPS ends. So this is 237,500. However, you will also add the potential equity shares. Potential equity shares on your calculators are 10 crores. They will convert into 10 crores equity shares. Just to be doubly safe, you will take that on your calculator, 10 crores, and then divide it by 1000 to exactly see how it appears. So this is 1 lakh. So this is plus 1 lakh in thousands shares on conversion, and as a result, this is 13,733 into 0.75, which is around 10,299, or this is 35,000 plus 10,300 upon 337,500, in which case you will have 35 plus 10,300 divided by 337,500, which comes to rupees 0.134. You will compare this with the basic EPS, which was, I guess, 0.147, and hence this is lower. So we can take this as diluted. Quite a few reference notes are also given, so I strongly recommend you go through those reference notes once for a better understanding of this concept as well. So that takes care of question number 16. Next, what we can do is we can try to do question number 17, and then we can stop for the day. The remainder we can do in tomorrow's class then. Now, actually, before you go to question number 17, there is one concept that you need to cover, which is on options. So probably 17 we'll do in tomorrow's class only. You have to cover options, which we are yet to do. So what we'll do is we'll go back and finish those two questions which were left for options. I think question number, 12 and 13. So we have studied about convertible debentures, convertible preference shares with EIR, without your market rate of interest. We have covered with multiple conversion options, everything. Now, we have done a fair bit of detailing on convertible debentures and preference shares, but are these the only categories of potential equity shares? No, sir. Can there be other potential shares? Well, of course. For example, you can have options, like you have ESOPs, or let us say warrants. You can have options as well. What are options? These are options whereby a holder can convert or exercise these options and get equity shares. Now, how would things change? So for example, there is a company where these are not options given to, let us say, employee. It is option given to a financial investor. There's a company which has a net profit, let us say, of rupees 1 lakh, and the number of shares outstanding, let us say, are standard 10,000. However, this company has also issued options. These are options issued to financial investors like mutual funds, and these are, let's say, the number of options are 1000. The ratio on conversion is 1:1, which means one option gets converted into one equity share, but options also have an attached exercise price. So for example, the exercise price is 50 rupees. Okay, so if I were to calculate the basic EPS over here would be 1 lakh. The options are not yet converted, so you will take the actual shares only, and hence the basic EPS comes to rupees 10. However, the moment I sit to calculate the diluted EPS, a very important fundamental difference has to be studied here. When I sit to calculate, let us say, the diluted EPS, in the diluted EPS calculation, I will take 1 lakh and I will add or less any expense which are attributable to options. Now, typically, you don't pay any interest to the option holders, you don't even pay any dividend, but sometimes it might happen that these options are classified as financial liabilities, in which case FVTPL accounting might apply, in which case there might be a fair value gain or fair value loss. Options may also be classified as equity. For example, they may be settling for a fixed number of own equity shares at a fixed price, and hence they can be classified as equity, in which case there may be no fair value gain or loss. The point is, if there's a fair value gain or loss, you will add, otherwise you will ignore it. So let us assume there is no fair value gain or loss. Let us say they were classified as equity, so there's no add or less. However, if these options are exercised, there is going to be no expense that you save or no income that will be foregone, and hence no adjustment in the numerator. In the denominator, you have 10,000 shares, and if these options are exercised, then one can say that against these 1,000 options, you will issue 1,000 shares, and hence 1,000 is added in the denominator, exactly like you do for convertible preference shares or convertible debentures. And this is where the institute says that it is wrong and a student has a problem. A student says, well, what is the problem over here? Well, the institute says you should add what is called as a free element. In loose terms, you can also name it separately. You will add only the free element in the options. Sir, why? We don't add just the free element in debentures and bonds. If a convertible debenture is getting converted into 10 crore shares, like in the last question, we add the entire 10 crores. Well, sir, why? Because when a conversion is happening, let us say, if a convertible preference share or a convertible debenture gets converted, the journal entry, please pay attention over here, if under the older standards would have been convertible preference share / convertible debenture account debit to equity share capital to securities premium. Even if you look at the IND AS, it can be liability component account debit, equity component account debit to, let us say, equity share capital / securities premium. Okay, so this would be the entry. However, when an option gets exercised, among other things, the journal entry would be bank account debit. Actual money is flowing in. For convertible preference shares as well as the convertible debentures, the actual money has already flown in, irrespective of whether the conversion happens or not. The money has actually come inside the company, which has been deployed and on which you must be even earning a return. And hence, even if the conversion is theoretically done at the start of the year, it is not that you are going to get a higher capital or more money. That money jitna aana tha, wo money company ke andar already aa gaya and you must have invested it. But the problem is, if you exercise an option, then the option holder will pay you, let's say, 1,000 into 1 by 1. So for 1,000 options, he is going to pay you 50 rupees. And hence, a capital worth 50,000 would have actually flown into the company. So you are saying that, okay, ultimately, let us say, to equity share capital / securities premium, jitna bhi amount hai, we will take it. However, what about the money? हाँ ठीक है यार, पैसे का क्या लेना देना है? Well, lena dena hai, because if money flows in, Well, to believe that you would have just earned 1 lakh rupees is wrong, because if you have a higher capital to invest or a higher money base, you can actually invest that and earn a slightly higher profit as well. Sir, but वो तो convertible debenture and preference share में भी है. In convertible debenture and preference share, the money that flows in is irrespective of the conversion. Even if the conversion happens or the conversion does not happen at the time of issue, whatever money had to come has already come in. But in case of option, if it is exercised, only then will the money come in. And you can't ignore the fact that money is going to come in, because this money could have been deployed, and on deploying that, it could have been, you could have earned some profits. So when one says that you should consider all the impacts of conversion, one of the impact of conversion over here or exercise, especially in case of an option, is the fact that money will come in. Now, money coming in is not income, it's capital in nature, it is not revenue in nature, it is bank account debit to share capital, for example. But this money could have been invested, and on investment we could have earned a return. Now this is highly debatable and contentious, which means kitna percentage return kamayega. Someone would say on 50,000 we would earn a 10% return, someone would say I would earn a 15% return, someone would say that aajkal to jo cash burn chal raha hai, we could have even done a loss. So this is very debatable, and hence this will give rise to inconsistency in accounting, and there is no one metric or measure through which every company can say what it will do with the money. And as a result, we can't ignore the money that is coming in. However, what we will do is we will assume a potential end use of the money. This is not necessarily going to be the end use, and in 99 out of 100 cases, this will not even be the actual position. But well, we have to do something with the money, otherwise you are wrongly just blindly adding 1,000, ignoring the fact that 50,000 rupees are coming in, and that 50,000 rupees could be used for some purpose. So what does the standard assume? Among other things, it says that this money that you will receive, let us at the beginning of the year, will be used throughout the year to buy back the company's own equity shares. Let us assume we have no end use of the money. Then what will you do? Well, we were under an obligation to issue shares, we issued, but this money, what will we do? We will go to the stock market over the course of the year, and we will buy back our own equity shares, because we don't have any other end use theoretically, notionally, for this money. Achha, if you go to buy back in the stock market, what is the prevailing price? Let us say 80 rupees. Again, the other argument would have been, when will we go? We will go on the first day, we will go middle of the year, we will go end of the year. Institute says, okay, take the average price throughout the year. In which case the average price is taken. Sir, but ऐसा जरूरी थोड़ी ना नहीं है, मैं आपको बोल रहा हूँ नहीं है. But the problem is, then every company and every management will have a different notional return percentage on this money. However, you can't verify it. There's no audit trail. If there's an average market price, there is a trail. You can say that, okay, let us assume that the end use, not just for you, but for every company who is hypothetically assuming that these instruments would have converted at the beginning of the year, we would have received money. The end use of the money is to buy back your own equity shares. And if you were to buy back your own equity shares throughout the year, let us say that buyback would have happened at the average market price throughout the year. Acha, which means what would happen over here is, at the course of buyback, the journal entry would be equity share capital / premium or reserves account debit to bank. And hence this 50,000 which has come in will actually go out. But when that 50,000 is coming in, you are in that process issuing, let us say 1,000 equity shares. 1,000 equity shares, let us say, are issued. But when, what will you do with that 1,000 equity shares? Well, 1,000 options will give you rupees 50, that is 50,000. You will go to the stock market to buy back these shares, but this buyback is going to happen at the market price, that is 80 rupees. And as a result, this is notionally the shares bought back. In which case, this will be 1,000 equity shares minus 50,000 rupees. Say we can buy back, let us say 625 shares. And hence, money coming in resulted in you issuing potentially 1,000 shares. That money being used potentially for buying back 625 of the company's own equity shares, and hence after considering the utilization for that 50,000 rupees, you are left with 375 shares, and that 375 is going to go in the denominator. Sir, why don't we do this for convertible options or debentures? Because in convertible options or debentures, there's no money coming in. Look at the journal entry. Where is the actual flow of money which you can deploy on conversion? Conversion is a book entry. Over here, it is a mere book entry but it is not a mere book entry in case of options or warrants where actual money is going to flow in, and hence we have to do something with that actual money. And hence institute says that let us notionally assume that this money is going to be used to buy back own equity shares. So 50,000 coming in, 50,000 going out, and as a part of that 50,000, you will probably buy back at the average price, which can be observed. You can't manipulate that because it can be observed. Okay, so this is something which is interesting and important. We'll go through our shield on page number 72 or 71 rather. Options or warrants, point 7, important. In case of conversion of debentures or preference shares, no additional consideration is received by the company at the time of conversion. Agreed. However, in case of options, cash consideration would be received on exercise. Okay. As this consideration is ignored, 50,000, what do you do with that 50,000 is ignored? Shares issued at fair value against this consideration should also be ignored. So one can say that ideally there are 1,000 shares that you are issued. However, for a fair value, you could have issued or you could have bought back as a case, maybe 625 shares. If you needed 50,000 rupees, 50,000 rupees could have been raised by issuing money at 80 rupees, which means you could have raised 50,000 by issuing 625 shares. You issued 1,000 shares, so that additional 375 is only the amount that is to be adjusted. Therefore, the adjustment should be made only for potential equity shares which may be issued without consideration, which is the free element. Don't treat this as bonus shares. Bonus shares can be issued on already existing shares. Ye to 1,000 shares aapne issue hi nahi kiye. So this can't affect the basic EPS calculation. These are 1,000 potential shares on which there can be potentially 625 shares that you can buy back, or potentially 625 shares that are without consideration. And as a result, we will adjust the free element. The free element is the shares issued on exercise, which is 1,000 minus number of options into exercise price. So this is the money value, 50,000 upon the average market price. Let us say this is rupees 80. Generally, there is no interest or dividend paid on options, and hence there will be no adjustment in the numerator. However, if options were measured using FVTPL, a fair value gain or loss would be adjusted in the numerator, because if the options are actually converted at the start of the year, then there would be no separate fair value gain or loss. In the denominator, we will add only the free element. Are we clear with this? Yes, another school of thought. So we have written over here for the free element, but we can also assume alternatively, it can be assumed that the consideration received on exercise, will be used to buy back own equity shares at average market price, and hence only the net value will be considered. Considering that, you will refer question 12 and 13. You can put one of them as important for option working understanding. So let us quickly finish that off and then we can stop for the day. So you'll have question number 12. Let us read this. As on 31st December 2017 and 18, the issued share capital of an entity consisted of 40 lakh ordinary shares of rupees 25 each. So there is no further issue, no further share adjustment. The entity has granted options that give the holders the right to subscribe, okay, for ordinary shares between 2016 and 2019 at the rate rupees 70 per share. So this will give you the exercise price, and you can convert them between 2016 and 2019. So they are potential shares between 17 and 18. Options outstanding as on 31st December 17 as well as 18 were 6,30,000. Okay. There were no grants, exercises or lapses of options during the year, which means they remain potential throughout these 2 years. the profit after tax which are attributable to ordinary shareholders for the year ended 31st December 17 and 18 amounted to rupees 5 lakhs and rupees 6 lakhs respectively. Relating wholly to continuing operations, that is okay, the average market price per share for the year ended 31st December 17 is 120, for 31st December 18 is 160. The average price can be different, and hence you have to calculate the basic and diluted EPS. So over here, let us say you look at question number 12. First you have the basic EPS. Let us say this is for the year 2017 and then for the year 2018. You will look at the net profit after tax. The net profit after tax is given to you as rupees 5 lakhs and rupees 6 lakhs. This is rupees 5 lakhs, this is rupees 6 lakhs. You will divide this by the number of shares. Acha, this number of shares, there has been no conversion, and hence these number of shares will continue to remain constant. There is no adjustment. This is 40 lakhs. And that will give you the basic EPS. This is 5 lakhs upon 40 lakhs comes to, I think, 0.125. And 5 lakhs upon, 6 lakhs upon 40 lakhs comes to 0.15. So this will give you basic EPS. Achha, then you look at diluted EPS, and for diluted EPS in the numerator there is nothing given. वैसे भी interest preference dividend you don't pay, but there's nothing given about any fair value changes, and hence we'll assume that there will be no adjustment in the numerator. However, in the denominator you will have to find a free element. How do you find a free element? Well, one can say that there are 6,30,000 options. If nothing is given, well, they have the potential to convert into equity shares. So these 6,30,000 options, let us say the free element you are trying to find first for the year 2017 could have been issued. They are potential for the year 2017, and if they were issued, then these 6,30,000 options ke samne we will get 6,30,000 into rupees 70 in our bank account. What will we do with that kind of money? 6,30,000 into 70. What will we do with that kind of money? Well, we will probably use this to buy back our own shares, which if we go in the market will be at 120. So around 4 crore 41 lakhs will come in on exercise, and this 4 crore 41 lakhs will be used to buy back. So this is 4 crore 41 divided by 120 will come to 3,67,500. So potentially you will issue 6,30,000 shares, and potentially you will use the money on issuing those 6,30,000 shares to buy back 367,500 shares, and hence your 262,500 shares would still remain. Now ignoring the fact that, or considering the fact that money is received 4.41 crores and that 4.41 crores is actually used, still there would be potentially 262,500 shares which will still remain, and hence they will dilute your EPS. Okay, so this is for 2017. If you go to 2018, this is again 6,30,000. However, this 6,30,000, if they were potential and they were converted during 2018, you would have received 70 rupees during 2018. There are two separate workings. However, during 2018, the average market price is 160, and if I had to buy back, I could potentially buy back how many shares? 6,30,000 minus, I could potentially buy back 630 into, let us say, 70 upon 160, which is I could potentially buy back 625 shares. So this is less 6,30,000. So this is 3,54,375 potential equity shares to be adjusted, and hence if I look at the diluted EPS calculation for 2017 as well as 2018, your numerator continues to remain 5 lakhs and 6 lakhs, but when we go to the denominator, you will have 40 lakh shares plus, let us say, 262,500, and in the denominator you will have 40 lakh shares and 354 375. So this is 5 lakhs divided by 42,62,500. So this is rupees 0.117. 6 lakhs divided by 43,54,375, which is rupees 0.138. And if you compare this, it has to be lower than the basic EPS. 0.125 say lower, 0.15 say lower, and hence this can be rated as diluted. Okay, so let me just verify this once. So this is 0.138 and 0.117. Perfect. So this takes care of question number 12. You'll also go through question number 13 once. I guess 13 is a slightly more easier version. We could have done 13 first as well. So 12 and 13. 13, on 1st of January, shares in issue are 10 lakhs. The profit for the year ending 31st December is 1 lakh. Okay, therefore your basic EPS, if you have to calculate, and even if it is not asked, you should always try to calculate the basic EPS just to ensure that there is dilution. In this question, it is only diluted EPS that is asked. But to ensure that there is dilution, you will have to compare the diluted EPS with the basic one. So you should always have a practice of calculating it. Average fair value during the period is rupees 8 and average fair value during the period is 8, and the company has issued 2 lakh options to purchase an equal ordinary shares. That is 2 lakh options will convert into 2 lakh ordinary shares. The exercise price is rupees 6. Calculate the diluted EPS. Well, over here you will have to calculate the free element as well. If 2 lakh shares are converted, we will have to issue 2 lakh equity shares, but we will receive in the process 6 rupees. However, this 12 lakh that we would have potentially received, we will use to buy back our own shares, and hence 2 lakh shares we will potentially issue, and 12 lakhs divided by 8, 1,50,000 shares we will potentially buy back, and hence at the end of this entire process we will be left with 50,000 potential equity shares. There is no fair value adjustment given over here, so if you have to calculate diluted EPS, this is profit for the period, this is 1 lakh plus or minus 0, no adjustment, divided by 10 lakhs which is outstanding for the entire year, plus 50,000. And as a result, this will be 1 lakh divided by 10 lakh 50, which will come to, let's say, 0.095, which is lower than 0.1, and hence the diluted EPS over here will be taken as 0.095. 13 is slightly more easier. 12 is a little more tricky, so we can put 12 as also important. A good question for EPS with options. Perfect. So we will stop for the day, and we will continue tomorrow with the remainder of EPS. We'll try to cover up and finish the remainder of this chapter. We have question 17 up to I think question 21 ya kuch rahega, up to question 20. Okay, so we'll finish them. Most of these questions are still important. It's a fairly interesting chapter, and then we will go to the next topic. Okay, thank you very much for your time, and I'll see you tomorrow. Bye bye. Take care.